You have $1,000 to invest. You find MetroCoffee, a strong brand, almost 10% dividend. That's $98 per year. You check the stock chart. It is down 20%. Just $10 a share. It is a bargain, so you buy it. 1 year later, the dividend is cut. The stock price collapses and your $1,000 is now worth $600. You are sitting at your kitchen table, disappointed and confused, asking one question: how did I not see this coming? In the previous video, we opened the balance sheet. We saw the debt growing for 4 consecutive years. But there was another document we hadn't read yet, the income statement, and that's where the illusion begins. Charlie Munger once said, "Thank God we don't design bridges and airplanes the way we do accounting. The income statement is not lying to you. It just isn't telling you the whole truth." Hi, I am Nick, the guy with the Greek accent, a long-time value investor. After this video, you'll read an income statement the way intelligent investors do and find exactly what matters and what it is hiding. It is the video I wish had been around when I first started investing. It would have saved me from a stock that cost me 20% of my capital. The income statement answers one question: did this business make money over a quarter or over a full year? Think of your own household finances at the end of the year. Everything that came in, your salary, your side income. Everything that went out, the mortgage, the food, the bills. What is left is your profit or your loss. In your household, you record money when it arrives and expenses when you pay them. That is called cash-based accounting. Simple. This is how most people naturally think about money. But every public company you will ever invest in works differently. They use something called accrual accounting. So what is accrual accounting? In December, MetroCoffee signs a deal to supply coffee beans to a large hotel chain. They deliver $80,000 worth of beans. The hotel pays in 60 days, February. But MetroCoffee records that $80,000 as revenue in December, the moment the beans were delivered, not February when the cash actually arrives. The income statement says, "Great December." The bank account says, "We are still waiting for the cash." That is accrual accounting. Revenue is recorded when it is earned, not when the cash lands. This is not fraud. It is the standard rule every public company in the world follows. But it means one thing for you as an investor. Profit is always an estimate. Let's find where the illusion is hiding. To follow along, download the MetroCoffee income statement case study from the description. It contains all the important numbers and calculations in one place, so you can see exactly what we are analyzing. At first glance, everything looks fine. Revenue, $1.2 billion. Every cup of coffee, every pastry, every contract, including the hotel deal, all added together. A big number, a comforting number. Then the first subtraction. Cost of goods sold, $400 million. Beans, milk, syrups. The raw ingredients behind every sale. What is left? $800 million. So far so good. Selling coffee is one thing. Running 3,000 stores is another. Store operating costs, $550 million. Wages, rent, electricity, the cost of keeping the lights on, everywhere, every day. More than half the business gone. Now we are at $250 million. Still profitable, still looks healthy. Then a line most people don't think about: depreciation and amortization, $70 million. Here is what that means. Assets wear out over time. An espresso machine bought for $10,000 does not last forever. So instead of recording the full $10,000 as an expense in the year it was purchased, MetroCoffee spreads that cost across the machine's useful life, say 10 years at $1,000 per year. That $1,000 appears on the income statement every year, not because cash left the bank this year, because the machine is 1 year older. Now, multiply that across every espresso machine, every refrigeration unit, every renovation across 3,000 locations. That is where the $70 million come from. Investors have a name for this, a ghost expense, a cost that appears on the income statement real enough to reduce your profit, but no cash left the bank to create it. The machine was paid for years ago. The income statement is still paying for it today. But those machines will eventually need replacing. The income statement has been showing $1,000 per year. The actual replacement bill will be $10,000, arriving all at once. The ghost expense made the cost look manageable. The real cost is not. This is why profit and cash are never the same thing, and why one document is never enough. Now we are at $180 million. Then head office. General and administrative, $50 million. Executives, lawyers, accountants, the invisible half of the business. Now, $130 million remains. That's operating profit, or EBIT, from $1.2 billion to $130 million, and we are still not done. Interest, $15 million. That's the cost of debt. Taxes, another $15 million. The government's share. What is left is $100 million. Net income or profit. The number headlines celebrate. The number most investors trust and move on from. But net income has no memory. It tells you what the business earned. It does not tell you why. I learned that the hard way. It was my first year investing. I bought a plastics company with record earnings and thought that those record earnings would last forever. 3 years later, when the earnings collapsed back to reality, I was down 20% of my capital. The profit was real. The reason for it was temporary. One income statement cannot tell you if this year is normal or an exception. Only when you line up 3, 4, 5 years side by side does the pattern reveal itself, whether this year is sustainable or whether it belongs to a moment that has already passed. We will dedicate an entire video to that process. It is one of the most important habits an intelligent investor can build. If you don't want to miss it, subscribe. It will be worth your time. Now, even when you know earnings are sustainable, even when the trend confirms this is a normal year, net income is still the wrong place to stop. Not because of earnings quality, because of distortion. Net income is distorted by two things that have nothing to do with how well the business actually runs. Debt, which depends on how management chose to finance the company, and taxes, which depend on where in the world the company is located. Two companies in the same industry running identical operations can show completely different net income figures simply because one borrowed more money or is based in a different country. Operating income strips both away. It shows you the pure earning power of the core business before the financing decision, before the tax regime. Just, does this business doing what it does every day actually make money? For MetroCoffee, the answer is yes, $130 million. Operating income is the first number in the income statement I will point to when I show my daughter how to invest one day. And if you have someone in your life, a partner, a child, a friend, who just lost money on a stock they trusted, this is the number to show them first too. Now let's put these numbers to work, because operating income becomes most powerful when you use it in two ways: comparing two businesses in the same industry side by side, or tracking the same business across the years. You already know MetroCoffee, $1.2 billion in revenue, $130 million operating income. For every dollar MetroCoffee collects, it keeps about 11 cents after running the business. Now meet Daily Brew, a smaller competitor, 800 locations versus MetroCoffee's 3,000 locations. $180 million in revenue, 1/7 of MetroCoffee's size. Operating income, $27 million. At first glance, MetroCoffee looks like the stronger business. 7 times the revenue, nearly 5 times the operating income, bigger brand, more locations. MetroCoffee wins on every number except one. Daily Brew keeps 15 cents of every dollar it earns. MetroCoffee keeps 11. The smaller company runs a cleaner, more efficient business. Every location is more profitable. Every dollar of revenue works harder. And there is one more difference. Daily Brew pays 0 in interest expense, no debt, none. Its operating income and net income are almost identical. The only deduction between them is tax. Nothing is being taken out to service a growing loan. MetroCoffee's $15 million interest expense is permanent. It is the fixed cost of borrowing, and MetroCoffee has been adding to it every year for 4 consecutive years. Debt is a landlord that never gives you a month off. It doesn't care if people stop buying coffee or if the economy crashes. Same industry, same product. Very different businesses. Operating income showed you the difference in 30 seconds. In the last video, we found MetroCoffee's long-term debt, $120 million, growing every year for 4 consecutive years. And we asked one question: how many years will it take to pay it off? Now we have the number we need. Net income, $100 million. If MetroCoffee used every dollar of profit to pay down debt, every single dollar, nothing else, it will take just over 1 year. That sounds manageable. That sounds almost reassuring. But here is the problem. That $100 million is not cash. Remember the hotel deal. Remember the espresso machines. That profit was calculated using accrual accounting. The actual cash sitting in the bank after running 3,000 locations is a very different number. We need to know one thing. How much cash did this business actually generate? That number is not on this page. It lives in the next document, the cash flow statement. And when we open it, the $100 million profit becomes much less in real cash. That is the number that explains the dividend cut. And that is the number most investors never find because they stopped reading here. You no longer read an income statement the way most investors do. You read it the way intelligent investors do. If you want to keep building that edge, subscribe. Next week, we open the cash flow statement and find the number the income statement was hiding all along. I'll see you there.